Imagine waking up one morning, looking at your bank account the way you have done thousands of times before, and suddenly realizing that the quiet movements of your money are no longer as private, simple, or invisible as you thought. Not just the large transfers, not just the wire payments, not just the stock sales. Every deposit, every withdrawal, every time money moves from one place to another. Now imagine you are retired, you are living on a fixed income, you are not speculating, you are not hiding anything, you are not trying to outsmart anybody, you are doing what responsible people have always done. You are managing your savings, paying your bills, helping your family, and protecting what you spent a lifetime building. Then one day, because of one number, your account can be flagged, your funds can be questioned, a transaction you considered ordinary can start looking suspicious to a system that does not know you, does not understand your life, and does not care about your intentions. That number is $10,000, and as we move into 2026, that number matters in a different way than most retirees understand. This is not about panic. Panic is usually a sign that people do not understand the system they are dealing with. This is about understanding the system clearly, because once you understand how the machine works, you can stop being surprised by it. That is one of the most important principles I have learned in markets, in debt cycles, in governments, and in life. When people do not understand the rules, they personalize the consequences. They think the system is attacking them personally. Usually, the truth is colder than that. The system is doing what it was designed to do, and it does not care who gets caught in the process. That is why this matters so much for seniors. If you are retired or approaching retirement, the money in your account is not just money. It is your time. It is your work. It is your security. It is your ability to say yes to a medical bill, yes to a roof repair, yes to a grandchild who needs help, and no to becoming dependent on someone else. So when a rule begins to interfere with how you move that money, you need to understand it before it touches you. Let me start with Patricia, because stories are often the best way to understand a system before we name the mechanics behind it. Patricia is 71 years old. She is a retired school teacher in Ohio. For 35 years. She taught third grade. She lived carefully, she paid her taxes, she did not take foolish risks, she never tried to hide money from anybody. Every month, her Social Security deposit arrives in her checking account. She has a small pension, she has savings. Every few months, she moves money from one account to another when life requires it. A roof repair, a medical bill, a trip to visit grandchildren, a family expense, a withdrawal from savings because prices keep going up and fixed income does not always stretch the way it used to. To Patricia, these transactions are normal. They are part of being retired, they are part of managing life. But to an automated financial surveillance system, Patricia is not Patricia. She is a pattern that is the key in a modern financial system. Your intentions are often invisible while your patterns are visible. The system does not know that she taught children how to read. It does not know that she saved carefully. It does not know that the larger transfer was for a roof, or that the cash withdrawal was for a family emergency, or that the deposit came from selling personal property. It sees movement, it sees timing, it sees amounts, and when the amount begins to circle around $10,000, or when several smaller amounts begin to look like they were designed to stay below that line, the system starts paying attention. That is how an honest retiree can end up looking risky without doing anything wrong. To understand why, you have to go back to the origin of the rule. The $10,000 threshold comes from the Bank Secrecy Act of 1970. The purpose of that law was not originally to monitor ordinary retirees. It was designed to help the government detect money laundering, tax evasion, drug trafficking, and other illegal activity. At the time, $10,000 was a very large amount of money. It represented a level of cash movement that was unusual for a normal household. If you adjusted that number for inflation, $10,000 in 1970 would be roughly $80,000 today, but the number did not adjust. That is the basic problem. Many things in the financial system adjust over time. Social Security benefits adjust. Tax brackets often adjust. Wages and housing prices and medical costs and retirement account balances all moved higher across decades. But this threshold stayed frozen. And when a threshold stays frozen while the world around it changes, the net becomes wider without Congress ever having to openly widen it. That is how a rule created to catch unusual cash behavior begins to catch ordinary life. A used car can cross $10,000, a home repair can cross $10,000, a medical bill can cross $10,000, a required minimum distribution can cross $10,000, a gift to a child or grandchild can cross $10,000. A home sale, inheritance, insurance payment, or retirement account transfer can cross that line many times over. So the rule did not have to change in order to become more powerful. Inflation changed the world around the rule. This is one of the great lessons of systems. Sometimes the most important change is not the rule itself. It is the interaction between an old rule and a new environment. Now, banks have two important reporting tools that matter here. One is the currency transaction report. A bank files this when a customer makes certain cash transactions of $10,000 or more. For most people, that report is filed in the background and nothing happens. The other is the suspicious activity report that is much more flexible. Banks can file it when they believe a transaction or pattern may indicate suspicious activity, and that is where retirees can get into trouble. The word suspicious does not always mean criminal. It can mean unusual. It can mean inconsistent with your past behavior. It can mean an automated system sees something that statistically resembles a risky pattern. One of the most dangerous patterns is called structuring. Structuring is when someone deliberately breaks large transactions into smaller ones to avoid the $10,000 reporting threshold. If someone has $27,000 in cash and deposits $9,000 on Monday, $9,000 on Tuesday, and $9,000 on Wednesday, because they do not want the bank to report a $10,000 transaction, that can be structuring. And structuring is a federal crime. The problem is that many innocent people move money in smaller amounts for reasons that have nothing to do with evading a report. They are nervous about banks. They do not understand the rule. They think smaller transactions are safer. They grew up in families where cash was trusted more than institutions. They may be helping family members. They may be selling personal belongings. They may simply be following habits formed decades ago. But again, the system does not begin with the story. It begins with the pattern. And if the pattern looks like structuring, the system may react before anyone understands the innocent explanation. This is where seniors are especially vulnerable. A lot of older Americans learned money habits from parents who lived through very different environments. Some saw bank failures, some lived through periods of inflation, some watched their families struggle during hard economic times, some were taught that cash was security, some were taught not to trust institutions too much. Those habits can be emotionally rational but legally risky. A senior may make several smaller deposits because that feels safer. A senior may withdraw cash gradually because that is how they have always managed spending. A senior may receive help from family members in irregular amounts. A senior may hold cash at home and then deposit it in pieces. None of that necessarily means wrongdoing, but it can create a pattern that the system is trained to notice. There have been real cases where people had money seized or accounts frozen because deposit patterns resembled structuring, even when no criminal charges were filed. Civil liberties groups have documented cases involving small business owners and ordinary citizens whose funds were taken or frozen because the pattern looked suspicious, not because anyone had already proven a crime. This is why I say this is not only a tax issue, it is a risk management issue. And risk management begins with asking one question. How could this go wrong even if my intentions are good? Most people only think about wrongdoing. They say, I am honest, so I am safe. That is not how systems work. In any large system, there is a difference between being honest and being explainable. Honesty is what you know about yourself. Explainability is what you can prove to the system. In the modern financial system, you need both. Now, heading into 2026, the $10,000 threshold is becoming more important because the government and financial institutions have more data, better technology, and stronger tools for analyzing patterns that already exist. There was a major political fight several years ago over proposals that would have required banks to report much smaller account flows. That proposal created strong public backlash and was scaled back. But the broader direction did not disappear. The direction is toward more data, more automation, more cross-referencing, and more enforcement capacity. That matters because governments, like markets, move through cycles after periods of large deficits, large spending, and rising debt. Governments tend to search harder for revenue and compliance. They use the tools available to them. And today, the tools are data systems. When I look at this as someone who thinks in terms of cycles and systems, I do not see one isolated rule. I see several forces coming together, an old threshold that never adjusted for inflation, a population of retirees with larger nominal transactions than prior generations, more digital records, more automated analysis, more pressure on government revenue systems, more concern about fraud, scams, tax compliance, and money laundering. When those things interact, ordinary people can get pulled into systems that were not built with their daily lives in mind. That is the real issue. So let us walk through the practical areas where seniors may feel this most. The first area is Social Security, pensions, and retirement account distributions. Most monthly Social Security or pension deposits are below $10,000. For many retirees, those are predictable and routine, but retirement life does not move in perfect monthly lines. Large expenses come in waves. A retiree may take money from an IRA. A retiree may take a required minimum distribution. A retiree may move money from savings into checking. A retiree may cash out part of an annuity or investment account to cover a large cost, depending on account size. Those distributions can easily exceed $10,000. The transaction itself is not the problem if it is properly documented and properly reported. The problem begins when the money moves through accounts in a way that does not match the tax return, the account statements, or the available explanation. If you take a retirement distribution, it should be traceable. If you receive a pension payment or a retirement account transfer, there should be paperwork. If your tax return does not clearly reflect what happened, or if you cannot show where the funds came from, the system may ask questions. In most cases, questions are not disaster, but questions become stressful when the person receiving them does not have records, does not understand the process, and does not know who to call. The second area is gifts to family members. This is one of the most normal things seniors do. They want to help a child buy a house. They want to help a grandchild with school. They want to give money while they are alive so they can see the benefit that desire is human and often generous. But the financial system does not simply see generosity, it sees transfers. If the amount is large, or if the transfer is repeated, or if cash is involved, it can create reporting and documentation issues. Large gifts can have gift tax reporting rules even when no gift tax is actually owed. Many people misunderstand that. They think a reporting requirement means a tax bill. Often it does not. But failing to document the gift can create confusion later. If Patricia gives money to a grandchild for tuition, that may be completely legitimate. If she gives an adult child money for a down payment, that may be completely legitimate. But she should know how the money moved, when it moved, why it moved, and whether a tax professional should document it. The goal is not to avoid every report. The goal is to make every large transaction explainable. The third area is home sales, inheritance, and major life transitions. As people age, money often moves in large lump sums. A spouse dies, a home is sold, a person downsizes, a parent leaves an inheritance. An insurance payment arrives. A retirement account is transferred. These are not suspicious events. They are normal life events. But they can produce large transfers that look unusual compared with an account holder's ordinary monthly behavior. Suppose a retired couple sells a house and deposits a large amount of proceeds. That money has a clear source, but only if the closing documents are preserved. Suppose a widow receives an inheritance. That money has a clear source, but only if estate documents and transfer records are preserved. Suppose a senior moves money after selling a car, jewelry, furniture, or collectibles. That may be legitimate, but if the transaction was informal and paid in cash, the documentation may be weak. A weak paper trail does not make someone guilty, but it makes them more vulnerable. The fourth area is everyday senior finances. This is where the issue becomes subtle. Many retirees do not think of themselves as making major financial moves. They think they are just living. They sell a used car, they collect rent from a tenant, they help a family member hold money temporarily, they deposit cash accumulated at home, they transfer funds to someone who is helping them manage bills, they receive reimbursements from relatives, they pay contractors, they move money between accounts because one account pays better interest than another. Each event can make sense in isolation, but a system sees the total pattern. A series of cash deposits, transfers in and out, amounts just below reporting thresholds. Family members appearing in the transaction history, large changes from prior behavior. That is why a person can say, "I did nothing wrong," and the system can still say, "We need to review this." Both can be true at the same time. That is what makes this dangerous for seniors. It is not that every transaction will create a problem. It is that the cost of being one of the exceptions can be very high. Now, what happens when a bank reports a transaction? Most people imagine something dramatic. They think a report means an immediate audit. That is usually not true. When a bank files a currency transaction report or suspicious activity report, the information goes into government systems. It may be reviewed. It may never be touched again. The volume of reports is enormous. Most people whose transactions are reported are never contacted. That is important because fear makes people make bad decisions. The correct response is not to panic. The correct response is to be organized. But if the system does take a closer look, several things can happen. You may receive a letter asking for an explanation or documentation. You may face questions about income that does not appear to match deposits. You may be audited. In more serious cases, if structuring is suspected, funds can be frozen or seized through civil asset forfeiture. Civil asset forfeiture is one of the most serious risks in this area because it changes the normal feeling of justice. Most people believe the government must prove you committed a crime before taking your property. In civil asset forfeiture, the government may seize funds based on the theory that the funds are connected to illegal activity, and then the burden can shift to you to fight for the money back. For a wealthy person, that is a legal problem. For a retiree living on fixed income, it can be a life problem. If $20,000 or $30,000 is frozen, that may be the emergency fund, that may be the roof money, that may be the medical money, that may be the money needed to stay independent. Even if the retiree eventually wins, the delay in legal expense can do real damage. That is why the best defense is not winning the fight after it begins. The best defense is reducing the chance that the fight begins at all. So what should a prudent person do? The first principle is simple. Keep records before you need them. Most people start documenting after a problem starts. That is too late. Good documentation is most powerful when it is created at the time the transaction happens. If you sell a house, keep the closing documents. If you receive an inheritance, keep the estate documents. If you take a retirement distribution, keep the statement. If you sell personal property for a meaningful amount, write down the buyer, date, amount, and purpose. If you give money to a child or grandchild, keep a simple record of the date, amount, recipient, and reason. If money is moved between your accounts, preserve the account statements showing the path. This does not require complicated software. A folder works, a notebook works, a spreadsheet works better. The important thing is that the story of the money can be reconstructed. That is the principle. Money that has a story is much safer than money that only has a pattern. The second principle is to talk to a tax professional before major moves. Not after. Not every tax preparer understands retirement income, required minimum distributions, gifts, account transfers, or the reporting issues seniors face. You want someone who understands the intersection of retirement, taxes, and documentation. A good CPA, enrolled agent, or tax attorney can help you make the transaction legally, document it properly, and avoid patterns that create unnecessary suspicion. This does not mean you need a professional for every small move. It means that before large transfers, large gifts, inherited funds, home sale proceeds, or complicated family transactions, you should ask for guidance. The cost of advice before the problem is usually far lower than the cost of defense after the problem. That is true in investing. It is true in taxes. It is true in life. The third principle is to avoid the appearance of structuring. This is where many honest people get into trouble. They say, I do not want to make a $12,000 deposit because that sounds like it will trigger something. So I will deposit $6,000 today and $6,000 next week. That feels safer to them. It is often more dangerous. If the money is legitimate and you have a legitimate reason to deposit it, then depositing it as one clear transaction with documentation is usually cleaner than breaking it into pieces. Because of fear, the report itself is not the enemy. The suspicious pattern is the enemy. A single documented $12,000 transaction is often easier to explain than several $9,000 transactions that look designed to avoid the threshold. This is one of the most important distinctions. Do not manage your money around fear of a report. Manage your money around clarity. The fourth principle is to understand your rights. If you receive a notice from the IRS or another agency asking about bank transactions, do not ignore it. Do not panic. Do not call and start guessing. Do not try to handle something serious alone because you are embarrassed or afraid. You have the right to representation. You have the right to respond carefully. You have the right to gather documents. You have the right to ask a qualified professional to speak on your behalf. Most problems caused by bank reporting can be resolved if the money is legitimate and the documentation exists. But they can become much worse when people ignore notices, give unclear answers, or fail to respond. The fifth principle is especially important for families. If you are helping an older parent or grandparent manage money, make sure you have proper authority and proper records. Good intentions are not enough. If you are moving money for someone else without clear legal authority, even if you are their child, you can create problems for them and for yourself. A power of attorney or similar legal authorization matters. Clear records matter. Family conversations matter. If an adult child is regularly depositing cash into a parent's account, the system may not see family help. It may see unusual cash flow. If a grandchild is reimbursing a grandparent in irregular amounts, the system may not understand the reason. If several relatives use one senior's account as a temporary holding place for money, that can look extremely confusing from the outside. Do not let family convenience create financial ambiguity. The sixth principle is to use clear payment methods when the amounts are meaningful. Cash creates the highest documentation burden. Checks and wires create clearer paper trails. Account transfers between known institutions are often easier to explain than cash deposits. If you are giving money to a child, consider a check or wire with a memo or documentation. If you are paying a contractor, ask for an invoice and pay in a way that creates a record. If you are receiving proceeds from a sale, keep the bill of sale and deposit it in a way that matches the record. This is not about hiding from the system, it is about making the truth visible. The seventh principle is to stay informed because the system is not static. Bank reporting, IRS enforcement, civil asset forfeiture, digital payment rules, and financial privacy are all changing as technology changes. What was low risk 20 years ago may not be low risk now. That is the nature of cycles. The rules may not always change loudly. Sometimes enforcement changes first. Sometimes technology changes first. Sometimes the practical risk changes before the public fully understands it. So a retiree cannot simply rely on the habits that worked in the 1980s or 1900s. A rule that felt distant then can become very close now. Now I want to address the emotional part because it matters. Many seniors feel angry when they hear about this. They feel watched. They feel treated like suspects after a lifetime of working, paying taxes, saving money, and following the rules. That feeling is understandable. There is a real tension between the government's desire to prevent financial crime and an individual's right to privacy and control over their own money. That tension has always existed. It becomes sharper as technology gives governments and financial institutions more ability to see and analyze transactions. I do not think the right response is denial, and I do not think the right response is outrage without action. The right response is to understand reality and operate well within it. That is one of my core principles. Do not tell yourself how the world should work. See how it actually works. Then make better decisions. If the system requires documentation, document. If patterns are being analyzed, avoid confusing patterns. If large cash movements create problems, use clearer channels where possible. If your family helps you, make sure the authority and records are clean. If you are unsure, ask before you move the money. This is not surrendering your freedom. It is protecting it. Now, there is another senior-specific issue that deserves attention, and that is cognitive decline. As people age, financial management can become more complex. Some seniors remain sharp until the end of their lives. Others begin to need help gradually. Families often step in informally before formal legal documents are in place. That is where risk can build quietly. Automatic transfers may continue after someone no longer fully understands them. A family member may move money for a parent without clean documentation. A senior may forget why a transaction was made. Multiple relatives may become involved. From the outside, this can look messy, and messy is risky. If you are helping an aging parent, do not wait until there is confusion. Get the legal authority in place, keep records, make sure the financial advisor, tax professional, and family members understand the plan. The goal is not only to protect money from the government, it is to protect the senior from fraud, family conflict, mistakes, and confusion. Scams are another major part of the picture. Older adults are targeted because criminals understand that many seniors have savings, trust certain kinds of authority, and may be more vulnerable to pressure. Many scams involve instructions to move money quickly, secretly, and often in amounts designed to avoid attention. A scammer may say there is an emergency. A scammer may claim to be from a bank, a government agency, a law enforcement office, or a family member in trouble. A scammer may tell a senior to withdraw cash, buy gift cards, wire money, or make deposits into accounts. When the victim follows those instructions, the transaction pattern can look suspicious. So the senior is harmed twice, first by the criminal and then potentially by the financial system that sees the suspicious movement, but may not immediately understand the person was a victim. If anyone asks you to move money with urgency and secrecy, stop those two words. Urgency and secrecy are the warning signs. Slow down. Call someone you trust. Call the bank directly using a number you already know. Talk to a professional before you move the money. A real emergency can survive a second phone call. A scam often cannot. Now, there is also a civic part of this. The $10,000 threshold has not been adjusted for inflation for more than half a century. Civil asset forfeiture remains controversial. The balance between enforcement and privacy is still debated. People have every right to raise those concerns with elected representatives and advocacy organizations. Seniors have political power because they vote, they organize, and they have lived experience with how rules affect ordinary households. But even if the law changes one day, you have to manage the rules that exist now. That is another principle. You can advocate for a better system while still protecting yourself inside the current one. Both are necessary. Looking ahead to 2026 and beyond, the main direction is not hard to see. There will be more data, more automation, more cross-checking between institutions and tax records, more pattern recognition, more digital payment trails, more enforcement tools that can process transactions faster than any human examiner could have done in the past. Some proposals may be blocked. Some rules may be modified, political control may change, but the technology trend is clear. Once a system can collect and analyze more data at lower cost, it usually does. That is why these habits are not temporary. Keeping records is not a temporary habit. Avoiding suspicious patterns is not a temporary habit. Using clear payment channels is not a temporary habit. Asking for advice before large moves is not a temporary habit. Family documentation is not a temporary habit. These are modern retirement skills, and most people were never taught them. They were taught to save. They were taught to work hard. They were taught to pay taxes. They were taught not to borrow foolishly, but they were not taught how to make their money explainable in a world where every pattern can be analyzed. That is the missing skill. Let me bring this back to Patricia. Patricia is not dangerous. Patricia is not a criminal. Patricia is not trying to hide anything, but if Patricia sells personal property in cash, deposits it in smaller pieces, takes a retirement distribution, helps a grandchild, pays a contractor, receives money from a family member, and does all of it without documentation, her account can begin to tell a story she never intended to tell. That is the danger. Not that Patricia is dishonest. The danger is that the system may misunderstand her. So Patricia needs a better system of her own. She needs a folder. She needs a record of large transfers. She needs a tax professional who understands retirement income. She needs to avoid breaking transactions into smaller pieces out of fear. She needs her family to stop treating her account like a casual holding place. She needs to use checks, wires, and documented transfers when the amounts are meaningful. She needs to know that if a notice comes, she should respond carefully with help, not panic. None of this is complicated, but it has to be done before there is a problem. That is how prudent people protect themselves. They do not wait for crisis to teach them the lesson. The most important idea in this entire discussion is this. The $10,000 rule is real. The frozen threshold is real. The increased ability to analyze bank data is real. The risk to seniors who do not understand the rules is real. But the solution is not fear. The solution is clarity. When your money has a clear source, a clear path, a clear purpose, and clear documentation, you are in a much stronger position. When your transactions are broken up, undocumented, cash-heavy, family mixed, and hard to explain, you are in a weaker position, even if every dollar is honest. That is the difference between being innocent and being protected. A lot of people confuse those two things. They think innocence is enough. In a perfect world, it would be in the world we actually live in. You also need evidence. You need a paper trail. You need a process. You need to think one step ahead of the system. That is how I would approach this if I were advising someone I cared about. Do not try to outsmart the rule. Do not try to hide under the threshold. Do not move money in ways that create bad patterns. Do not ignore letters. Do not let family members make informal transactions through your account without records. Do not assume that because you have done things the same way for 30 years, the risk is the same as it was 30 years ago. It is not the environment changed when the environment changes. The right behavior changes. That is true in markets. It is true in economies. It is true in retirement. It is true in banking. The people who survive and do well are not the people who cling to old habits, because the old habits feel familiar. They are the people who learn the new environment and adapt before the pain forces them to adapt. So if you are over 60, or if someone you love is over 60, take this seriously. Look at the last year of large transactions. Ask yourself whether each one has a clear explanation. Ask whether the documents are saved. Ask whether the family understands how money should move. Ask whether your tax professional knows about large gifts, distributions, sales, or transfers. Ask whether any deposit pattern could look confusing to someone who does not know the story. If you do not like the answer, fix it now. Not after a letter arrives, not after money is frozen, not after a family member has to reconstruct records from memory. Now, this is how responsible people manage risk. They look at the system as it is, they identify the weak points, then they build habits that reduce the chance of a bad outcome. You do not have to live in fear of the $10,000 rule. You do have to respect it, you do have to understand it, and you do have to stop assuming that ordinary transactions will always be treated as ordinary simply because they feel ordinary to you. The system sees what it can measure. It measures amounts, it measures timing, it measures frequency, it measures account flows, it measures patterns. Your job is to make sure that behind those patterns there is a clear, documented, rational explanation. That is how you keep control. That is how you protect the money you earned. That is how you help your family without creating problems for yourself. And that is how you move through a more automated financial world without becoming one of the people who learns the rules only after the rules have already hurt them. You worked your whole life to build what you have. You deserve to use it, protect it, share it, and enjoy it with confidence. But confidence should not come from ignoring reality. Confidence should come from understanding reality so well that you are no longer surprised by it. The rule is there. The threshold is still $10,000. The technology around it is getting stronger. The government systems are getting better at seeing patterns, and seniors are more exposed than they think, because normal retirement life now creates transactions that look large inside an old rule. That is the world as it is. The good news is that once you see it clearly, you can act clearly. Keep records, get advice, avoid structuring, use clean payment channels, coordinate with family, understand your rights, stay informed, and most of all, do not let fear make your transactions look worse than they are. A reported transaction that is honest and documented is usually just a transaction. A hidden, broken up, confusing transaction can become a problem. That is the principle. And if you remember nothing else, remember that. Do not make your money look suspicious by trying to make it invisible. Make it explainable. That is the safest way forward.